Welcome to the Three Edge Week in Review for the week of June 21st. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and today we have a special guest back with us, Bob Phillips. Bob is Managing Partner, Chief Technology Officer, and member of the Investment Committee here at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Bob and I will be taking a look at the impact of the pandemic on the way that people work. It's a topic that has touched all of us, and we'll look at the subject in terms of labor productivity and how these changes could impact the economy and the markets in the future. Before we get into that, we'll take a brief look at what happened this week in the capital markets. And in the week following the market's mini taper tantrum over the Fed's announcement that they may need to begin raising short-term interest rates in 2023 instead of 2024, economic data, which seemed to confirm the continuation of a robust economic rebound from the pandemic, had investors focusing once again on economic growth and away from concerns on inflation. Both equities and real assets, such as commodities and gold, bounced back from last week's declines, and U.S. equity markets once again reached new all-time highs during the week. Near the end of the week in Washington, there seems to be an agreement, and a bipartisan one at that, on an infrastructure package that will be focused on public transportation, road and bridge repair, and the installation of electric vehicle chargers on highways. And now let's shift our attention to today's topic. The onset of the global pandemic has changed many aspects of our lives, and in particular the way that we work. And now as we emerge from the pandemic, we will be finding out which of those changes prove to be more permanent. So today, with Bob's help, we're going to look at labor productivity in a post-pandemic world and consider the changes to the way that we work, which were brought on by the pandemic, that may be more permanent, and discuss what this could mean for the economy and the markets going forward. So Bob, perhaps the best way to start would begin with a definition of what labor productivity is, how it's measured, and why it's important, particularly in the post-pandemic world.
Thanks, Fritz. The overall definition of productivity is really the amount of output produced per unit cost. And that can be output in terms of products, services, or a variety of different kinds of things. But the cost component is obviously very important. And a major component of cost for almost every company and every business is the cost of labor. Clearly, the higher the productivity level, the more goods and services that can be produced for a given amount of labor cost. And that really is a key driver, because if you look at labor costs have really been fairly flat for a long time. People's salaries haven't gone up, and as a result, productivity has averaged around 2% over very, very long periods of time. But what we've started to see in the period post the pandemic are changes in those labor costs, and a concern has been, well, is that going to drive the kind of inflation that we've seen in the past in historical times? That can be the case, but if in fact productivity improves, that is, we can produce more goods and services per unit of cost, then costs can go up and still not have a dramatic impact on reducing growth. And in fact, growth can be enhanced. It's important to understand that while we look at this often through a U.S. lens, and U.S. being leaders in technology and in many cases the use of labor within their companies, this really has an international component as well, because a lot of the things that drive productivity enhancements are available in a ubiquitous way across the globe. And so it's important to not just focus on it as strictly a U.S. issue, but also an international one as well.
Excellent. So some of the most notable changes to society during the pandemic obviously revolved around the use of technology. And this technology was absolutely necessary because we were all forced to, stay in our homes or our apartments for over a year. And I know that technology and its application is an area that you understand as well as anyone. So perhaps you could provide a few examples of just how the rapid evolution of the uses of technology were such an important part of the pandemic, and what might be the consequences of those sort of accelerations of advancements in technology as we emerge from the pandemic in terms of the way that we all work.
It's absolutely true, and we've seen it in our own business how the impact of technology has driven improved productivity. And a lot of what you hear is fairly anecdotal. People talk about productivity improvements through the pandemic, but if you look at the chart, one thing you'll notice is that in March of last year, right at the peak of the pandemic shutdowns and things, you see a dramatic change in the slope of the productivity curve there. And
Hmm.
what happened was it truly there was a measurable surge in productivity on a month-over-month basis. And in fact, with a small dip in at the end of last year, the productivity change on a month-over-month basis has been running on a quarter-over-quarter basis, I should say, has been running north of 5%, which is significantly more than the long-term average and a lot more than what we saw in the previous 10 or 11 years, as shown on the chart. Why would that be the case? Well, it's a number of factors. Technology clearly plays a key role, but it's particularly technology that allowed people to be more productive in the way that they do their jobs. We've all suffered from Zoom and Teams fatigue, but the fact of the matter is that having that technology and the ability to meet in a way that before had only been really feasible in an office space, or more typically in traveling to meet clients, that you could have multiple meetings across a day across large geographies. In our own business, we've seen our team that works closely with our clients be able to meet with multiple clients in a day scattered across geography ranging from the West Coast to the East Coast, which would not have been feasible without that technology. And it's really the adoption of that approach and the acceptance of that approach on behalf of clients that has been a key driver. It shows up in other industries as well. I'm sure everyone has done a lot more online ordering of food, whether it was delivery of groceries or just meals, prepackaged meals, and that really was a survival mechanism for a lot of restaurants and a lot of food providers. But I think what you find going forward is that it's hard to think of starting a new restaurant, for example, without providing an online ordering capability and a takeout capability. It's become an accepted part of that approach. And if you look at and actually talk to restaurant owners, what they say is that they have to readjust their production capabilities to really deal with online ordering and takeout, but that in many ways it can be more efficient than sit-down dining because of the structure of technology that allows them to simplify the taking of an order, the production of an order, and then the delivery of an order out to individuals. So those are a couple of examples that both we've seen and I'm sure all of us have experienced during the pandemic.
Absolutely. I think the interesting part about that, if you think about doing those Zoom calls, it was the acceptance by the client, or the end client, more than willing to do it that way, and don't see that changing going forward. Thanks for that. So here's a really important question for you, because obviously recently investors have been struggling to understand whether inflationary pressures that have emerged as the world economy rebounds from the pandemic, will these inflationary pressures end up being transitory or not? And one area that we already mentioned that will be important in terms of how transitory any increase in inflation will turn out to be will depend on large part whether or not we see increase in wages and how dramatic those increases in wages are, because increases in wages don't tend to be very temporary. They end up sticking around, and you could get, as you mentioned earlier, that wage price inflationary increase. So I guess the question is, will technological advances that were accelerated during the pandemic and the commensurate gains in labor productivity help the economy to avoid the onset of wage price inflation?
I think that's a great question, Fritz, and I think it's a very important one. This idea of wage price spirals, which occurred, for example, most dramatically in the 70s, but have occurred periodically over time, are typically accompanied by very low rates of productivity. For example, in the period from 1973 to 1979, productivity growth averaged about 1.2%, significantly below the long-term average that we had seen. And that was a big driver because, quite frankly, what was happening was wages were going up, uh, prices were going up because producers couldn't afford to produce given the wage increases unless they raised prices. And without productivity, that meant that overall you got into this vicious cycle of everyone asking for more money, but then prices going up, and so the purchasing power associated with those wages was staying flat or decreasing, even though wages were going up, and that kind of spiral led to significant challenges for growth, and ultimately very, very high inflation. What's hopeful about the current environment, and one reason why we might think of what we're seeing now as more transitory, is the fact that productivity, for example, in the first quarter of this year was 5.4%. Now, that was during a time when wages were going up. Now, we still have a lot of unemployed people, and there's still a lot of challenges in the economy around that. But the fact of the matter is that we are seeing growth and wage growth, and we are seeing price increases, but that productivity number, at least from a labor cost perspective, is what gives companies the opportunity to grow, but not necessarily, and to pay more, but not necessarily inhibit, have to pass along those prices.
Right.
And I think that technology plays a huge role there. I mean, another great example is something we use with our clients a lot, a tool called DocuSign. And what it is, it allows people to sign documents electronically. And if you look at the amount of friction that reduces for us, and frankly for clients in many cases, it's very dramatic. There's no real value add to shipping paper to someone, having them to figure out where to sign it, send it back to us. And so I think those kinds of reductions in the friction of just doing business that can actually be improve the client experience, make it easier for our clients, makes it possible for us to see this kind of growth, to increase wages, but also see these increases in productivity. And the good news is that while technology clearly will replace some jobs, and that there'll be reskilling that's required, if we can find productivity growth, then ultimately everyone wins, because wages can go up, and we can produce more at constant, or even in some cases reduced prices, and that's generally good for the growth of the economy. It's generally very good for business because they can sustain their profitability, which is good for the markets. And
Right.
And again, that's not just something that can influence companies here in the U.S., but actually companies worldwide. Because what's happening, obviously, is and has been happening for a while, is that the opportunity to arbitrage labor rates by simply shipping things offshore, while still possible, is becoming harder because, frankly, labor costs are growing everywhere. And so the winners in the next round of economic growth are really going to be those people that can tap into technology in a way that increases the productivity of the folks that they have working.
Excellent. That is an incredibly interesting topic, and you explained it incredibly well. And I think it's not necessarily something that investors have perhaps been paying enough attention to, as we have this, debate about inflation and how permanent that inflation may be going forward. So thank you. And so that will do it for us. But we'll be back next week with another edition of the Three Edge Week in Review. And remember that all our videos are available on our Three Edge YouTube channel, as well as on our website at 3edgeam.com. So until next time, on behalf of Bob and everyone here at 3Edge, thanks for listening.